Good afternoon. Welcome to the Money Minutes. Happy Monday. I am Christina Ferrer with Be Your Best Financial. Okay, so a couple of housekeeping items. I actually did the blog last week, guys. Pretty proud of myself, the wrap up blog. So it is on the website right now. Go check that out. It really does a great job of putting more details and wrapping up the discussion that we had in the previous week. In case you missed any of that, we were talking about, even if your resolutions have failed, that there are still easy ways to get on track and have your best financial year yet with just like some really easy tips. So go check those details out if you missed them last week. And then moving on, this week my focus is on the billions. And I mean billions with a B of money that is sitting in money market mutual funds right now, today. I want you to know and I want you to remember that it's so important to have an emergency fund for anything that comes up, and that's the cash that you are allowed to have. If you have cash other than your 3 or 6 month emergency fund, depending on your situation, that's a mistake. That is a disaster. If you have money sitting in cash, let's talk. Okay, I know there's been a lot of volatility in the stock market. I know there's been a lot of volatility in the economy. I know there's a lot of volatility in politics, and this makes us all very nervous about what is going on with our money, with our finances, with our investments, and we're nervous about that volatility. So the natural reaction is to move all of your money to cash so that you don't lose any. And this is the worst philosophy, the most detrimental behavior to successful retirements, to successful investors, to successful finances in general. Okay, so let's look at a couple of statistics. 1991 to 2021, the US stocks averaged 10.6% return. 10.6. The average investor only made 4.1%. Why is that? What happens? It is this tendency to get panicked, pull your money out, and put it into cash. Lots of people do it. Don't feel shame because of it, but let's work to correct that behavior. And look at another statistic. If you look at the returns on $100,000 from 1997 to 2021, you pick the right investments, you set it and forget it, you leave it there. So let's say you're investing in the S&P 500. Over that time frame, a fully invested $100,000 turned into just over $1 million, $1.025 million. The average return, 12.34%. On the other end of that, if you miss the 10 best days in the market, and we never know when those days are going to be, they generally happen when the economy is going really, really badly, when the markets are going down, 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 down. You're going to have these really big days that kind of pop. And if you miss just the 10 best days in that period from 1997 to 2021, so decades, right? Just missing the 10 best days, your return goes from 12.34% down to 8.06%. You lose more than 4% return. And your total at the end of the day, it's not over $1 million, $470,000. And I think we can all agree that's not enough money to retire on. It's just not enough anymore. That will not give you the lifestyle that doesn't continue for you needing part-time work or to stay working. That's not what we want. So bottom line, key takeaway, you have to pick the right investments and stay invested. Moving in and out really, really tanks your returns. And sitting in cash is never, ever, ever the right choice.